Right, so we have had a very busy week in the markets because we've learnt a number of important things about the major economies and by extension the major currencies. The first really data point that's popped out in the last couple of days is US retail sales, which came in well below expectations. Admittedly, we have seen some pretty solid upwards revisions to previous months of data, but overall we haven't seen the large splurge in spending from the US consumer that some analysts were looking for. What this means is that potentially Q2 economic growth could come in slightly on the shy side, and it just puts a bit of a question mark over just how early the first interest rate hikes will be from the Fed. Now, in the meantime, in the European Union, we've seen the exact opposite. We've seen some very strong economic data from the Eurozone, in particular places like France and Italy that haven't been performing very well recently have posted some really strong Q1 growth. Now, the implication of this is that we can very clearly see that the ECB's quantitative easing program is performing exactly as advertised. So I think Mario Draghi and his ECB colleagues can take a bit of a pat on the back because the measures they've taken are clearly helping the economy and they're helping business confidence. Looking ahead, under these sorts of circumstances, the next thing to look for really is a bit of a drop in unemployment, which is the big political victory that I think a lot of leaders in the Eurozone are looking for. In the meantime, in the UK, we've seen another example of a fence-sitting inflation report from the Bank of England. What I mean by that really is that we haven't gotten a clear indication of where monetary policy is heading in the United Kingdom, or even what the Bank of England's opinion of the economy is. We got a very balanced assessment of the risks up and down to the economy and to inflation. So on the upside, we've got the fact that at any moment slack could run out in the economy and we could see wages and inflation begin to pick up very rapidly. But on the downside, we've got fiscal drag in the form of the fact that potentially we could have another round of austerity from the newly elected government. So really, considering all these factors and the fact that there is a lot of uncertainty in the outlook on the UK economy, I think that caution remains the right policy on the part of the Bank of England. Reading between the lines of all of these developments, we've seen government bond yields increase across the board, and a lot of spectators have called this a super taper tantrum. But the reality is all we're seeing is markets respond to the improvement in recent fundamental data, which does suggest perhaps a slightly faster rate of inflation across the Western economies. So this isn't a taper tantrum really, it's markets pricing interest rates off the back of economic developments as opposed to just taking central banks' promises of forward guidance that rates will remain low. So looking ahead, I think we will continue to see a trend of markets once again pricing interest rates as opposed to central banks, and certainly the volatility that that's created isn't going anywhere anytime soon.